I'm Lisa Smith. I'm part of the Farmer McClellan team based in Washington, D.C., and I'm also a member of this year's Trends in Ag Committee. We've already heard about what an exciting time it is for agriculture, and a significant part of that stems from the developments in international trade. With the most modern, innovative, and productive agricultural system in the world, the U.S. enjoys a long-standing comparative advantage in agricultural trade. Exports are advancing profitability for farmers and creating economic activity in rural communities around the country. That said, world demand is not only growing, it's also changing, and we as an industry need to be proactive in our response to that change. Today's panel will discuss some of the key elements needed to meet that growing export demand. Today it's my privilege, and it is a privilege, to introduce our moderator, Sara Wyant. It's not all that unique to find an Iowa farm girl with work ethic, but what sets Sara apart is her ability to blend that sheer determination with a fierce entrepreneurial spirit, the savvy to hold her own both inside the Beltway and out in the countryside, and a deep knowledge of the issues affecting our industry. I've known Sara since I was still in pigtails and she was writing about my dad's hog operation in Wyoming, but she was also instrumental in helping me get my feet on the ground in DC. Today, Sara is president of Agri-Pulse, a thriving, diversified communications firm with a newsletter and website familiar to most of you in this room. Without further ado, please help me welcome veteran farm reporter and agricultural leader, Ms. Sara Wyant.
Well, thank you, Lisa. That's a very kind introduction. And Lisa's from a great farm family out in Wyoming and has cut her own successful path in Washington, D.C. And it's an honor to be here with her and the rest of you this morning as we look at our second session focusing on progress through productivity. Thanks to all the farmers and ranchers. I know you heard the panel earlier this morning, and many of you who are still here in this audience, but thanks to the farmers and ranchers in America, we are considered in the United States a terrific, abundant, reliable supplier for the U.S. export market. But as Lisa mentioned, we need to be ahead of the curve. And so during this session, we're going to focus on some of the current trends in export markets as well as the challenges that lie ahead. This year and next, U.S. agricultural exports are on track to exceed $137 billion worth of value. Now that's leading to a trade surplus of over $42 billion, 8 times greater than only 5 years ago. Just consider the successful trend line that we've experienced with exports. And in addition to helping farmers and ranchers in the overall ag economy, which is a bright spot in the U.S. ag economic market, we are creating and saving over 1 million U.S. jobs from the people at the farm level that are in the trucks, in the trains, and along the waterways, and all the way from farm to forks all around the globe. But as Lisa mentioned, our customer base is shifting, and we're seeing new leaders emerging in our export numbers. In 2011, China moved ahead of Mexico and to be our #1 market for U.S. ag goods. Traditionally, Mexico and Canada have been at the forefront. And we're also seeing countries like Vietnam, one of the fastest growing economies, now number 15 in terms of the U.S. ag export market, up from number 50 just 10 years ago. So we've got an exciting panel to share not only what's been happening in U.S. ag exports, but to talk about those challenges ahead and give you that insider information that can help you go back and do a better job as you help manage these challenges. Our first panelist this morning, and I'm going to introduce all three, let them do their presentations, and then we'll open up for questions from our audience. Our first panelist this morning is Dan Basse, the president of Ag Resource Company with a domestic and international agricultural research firm located in Chicago. No stranger to many of you. His research is sold around the globe in over 81 nations. Dan's an economist who's been involved with a lot of different marketing businesses since 1979. You might have seen his name in the past with Professional Farmers of America, Brock Associates, and the Ag Research Division of GNP Commodities in Chicago. Up next is going to be our Vice President for Grain, Biofuels, and Fertilizer for Bunge North America, Bailey Ragan, in the middle here. Bailey is overseeing all origination for domestic and marketing activities, as well as strategic growth for Bunge's elevator network in North America. In 1998, Bailey moved to Bunge's North American headquarters in St. Louis to assume responsibility for the company's soybean crushing facilities in the South Central region. And then he transferred from that, the soybean processing unit, to Bunge's grain operation in 2002. And now he's had the additional responsibilities of biofuels and fertilizer in 2011. And last but not least is a fellow Iowa native, Mr. Tom Dorr, President and CEO of the U.S. Grains Council, a nonprofit organization based in Washington, D.C. that's committed to building and expanding international grain markets for U.S. barley, corn, grain sorghum, and their co-products. Tom coordinates the Council's worldwide staff and oversees market development activities in more than 30 countries around the world. And prior to his current role, he worked at USDA Rural Development as the Undersecretary. So let's express a great round of welcome for all three of our participants as we introduce Dan Basse and have him come forward.
Thank you, Sara, and welcome everyone. Good morning, and it's always good for me to be back to this meeting. I enjoy it quite often, and quite frankly, 3 weeks ago I was speaking to 350 Russians, and you look much more friendly than they do. You can imagine 350 people with headphones on. I spoke for an hour and a half, and I did not see a smile, a frown, or a disapproval of what I was saying in the whole speech. All I heard afterwards was vodka. And so, Russian agriculture is doing quite well. It's moving along, and I'm very, very impressed what's going on over there. Real quickly, I just wanted to speak to you for a few minutes of what's going on in agriculture and maybe set up our platform going forward. Now, as we look at agriculture from Ag Resources perspective, you know, I'll ask all of you, what is the driver of the bull market that we have been involved with, at least for the last 3 or 4 years? From our work, I would say it's really the twofold issue of biofuels and, of course, the rising caloric intake of Southeast Asia. I think those are the two combining events that makes this cycle in agriculture different than what we've had before. As evidenced here real quickly, you can see how world biofuel demand is going forward. We're now using approximately 200 million metric tons. Again, we are in the United States. Forgive me, I do a lot of international speaking. 200 million metric tons for biofuel production. And as we look at the expansion in world livestock demand, you can see where that's occurring to what I call Brazil, Russia, India, and China, the BRIC countries, the driving force as we go forward. But that being said, I wanted to set that background so you would have a little view of the export, because that's what our panel is about. This is global corn, wheat, and soybean trade. And as we look at corn and wheat, you can see some increase, but general stagnation with a little more volatility in the last couple of years. The real gains have come from oilseeds, principally from oilseed in China, the soybean demand from China, which has been the big driver. Now, as we look around the world, I want you to look quickly at where we're seeing the demand for global grain demand. And again, it's really domiciled, if you will, in that Southeast Asian corridor. This, of course, is world wheat demand, where if we look at the world, I mean, if I'm in the position of Bunge, I'm looking for opportunities to get to the Asian market, because that's really where we see things. This is corn. Same situation. Now in the United States, ethanol demand is starting to slow down. Europe and Russia, we're seeing some modification or increases because of an expansion of livestock herds within Russia. But again, it's Southeast Asia where the opportunity is, and the same for oilseeds. So as we go back in time, if we're thinking about trade, where I want you to be focused is probably Southeast Asia, and then to a lesser degree Latin America, just to kind of set that baseline. Now here in the United States, if I were to stack corn, soybean, and wheat exports on top of themselves, you can see that for about the last 20 years, what have we done? There's been some volatility, but generally speaking, not the same kind of increases that we've seen. I would offer to you today as an economist, and this is what we talk about in our shop, that we now see the United States as a residual supplier of commercial grains. Now I'm going to differentiate for you value added in a little minute here, but again, if indeed our friends in Russia have come back like they have this year, our export profile goes down. And so as I look at annual exports of corn and soybeans and wheat, notice the stagnation, if you will, in exports of wheat and corn. But again, it's oilseeds or soybeans that's been rising mainly because of China. Mainly because of China. And the volatility there, we find, is related to the supplies of other destinations. In terms of the U.S.'s grain trade world share, I've now added corn, wheat, and soybeans or oilseeds together. This year will be a record low in terms of our percentage of world trade. So the question for all of us is this what we want to have happen? How do we regain our competitive edges going forward? And maybe other panelists will have some ideas on that. If I look at corn exports out of the United States in particular, our driving fundamental crop, we're now at 43% of the world. We're about back to where we were in 1970. In fact, the trivia question for you today, when you're at that cocktail party Saturday night, you can go up to your friend and say, hey, this is the first year that the United States and the EU will export less corn than Latin America and the FSU, or former Soviet Union. We have Ukraine now exporting corn to Japan. We think they've sold as many as 16 or 18 cargoes within the last couple of weeks. Japan is our biggest export domicile customer for corn. These are important developments that are now happening. So you can see the dramatic change that's ongoing. And if we look at wheat, for the longest time, the United States held the crown of being the world's top wheat exporter. It's a little bit of a convoluted chart here, forgive me. The United States is that red line up above. I want you to focus on that blue line, which is our friends in the Black Sea, the FSU 12. They are going to recapture that crown this year of the world's largest wheat exporter. Why? Because, of course, they had a decent crop. The big drop last year is because they had a drought, and they of course, banned exports out of Russia. President Putin decided in July, I'm calling him president already, President Putin in July decided to reopen exports, and of course now the grain union would tell us that they will export somewhere between 24 and 25 million metric tons of all grains and somewhere in the vicinity of 18 million metric tons of wheat. And so when we look at this slide, you get a graphic of what we're up against. Now, that was the commercial grains. The Americans are doing very, very well in what I call value added. This is a graphic showing you U.S. ethanol exports. This year we will export 8% of our ethanol production overseas to, somebody's got to know. You guys are in agriculture. We're going to do 1 billion liters to who? Brazil. Brazil because of the price of sugar. So this morning we had a USDA crop report. The USDA raised their outlook for sugar prices. That means that our ethanol exports should continue to be rather robust going forward. Distillers' dried grains, DGGs, another value-added product. Of course, the Chinese have a trade issue against the United States at this point. We think it's getting slowly resolved. We're now seeing more interest. But again, DGG exports have been rising. Dairy production. Dairy production, we will now export 13% of our dairy production overseas this year, which has given the milk market the opportunity for Class 3 prices to come back to $21 to $22 a hundredweight this summer, largely because of what we call non-fat or powder exports into China. A very, very strong market. We're now seeing where dairies in California are using their dryers to produce whole milk powder, which of course is reducing the milk fat issue, thereby raising fat prices and cheese prices within the United States. Cotton exports, you can see here, of course, we're now in a declining position. We're down to about 30% of the world total. Again, we have come down from where we've been in the last couple of years. China figured very prominently last year in cotton's ascent to record highs. From my perspective, where the United States is doing the best is in the species. The species. And this creates a lot of anxiety, if you will, in the producer crowd. I can't tell you how many livestock meetings I'll go to. I'll throw up this graphic in which, in terms of production, we're now exporting 1 out of every 5 hogs, 1 every 10 cattle overseas, and how producers look at that as saying, boy, that sends me up to a lot of risk in the marketplace. Because if there's a phytosanitary issue on U.S. meat production, let's take, for example, some type of hoof and mouth disease, God forbid, or something like that, they look at where their fortunes would be. But today, for the month of November, we have record high cattle and hog prices from my work due to this export profile on meats. And if we look at globally, you can see that outside of poultry, because of the Russians, of course, not wanting to have what they call bush legs over there. The Russians don't like U.S. poultry. I mean, you go to any table and they'll tell you right away, no more bush legs. They remember George I and sending cheap dark meat to Russia, and they now want to be proud and have their own, of course, poultry. So the U.S. is trying to find ways to push their dark meat to other areas. But outside of poultry, there's been tremendous gains in pork and beef exports going forward. In fact, broiler exports haven't basically made new highs, but they've stabilized. But that's been a good thing even without the Russians. The key for that increase, though, of beef and pork and poultry trade is that in the United States we're seeing a decline in per capita consumption of total meat. I mean, I don't want to say we've all enjoyed chicken fatigue yet, but we're at a point, because of the economy, in which U.S. meat consumption has been in a declining profile. Now in the vicinity of 204 to 205 pounds per person. Of course, that peaked a little over 221 pounds. So for the livestock sector, the importance of trade cannot be overstated. In fact, this will be the first year in which U.S. beef exports are going to have a net trade that's positive, where we actually export more than what we've been importing from Canada and other sectors. So that's why we're seeing, along with the drought and, of course, the plains, while we have cash cattle trading just a few dollars from our all-time high at $124. Now, behind all of this has been the help of the U.S. dollar. I mean, commodity values this morning are hurt because the U.S. dollar is sharply higher on safe haven buying. The Italian bonds this morning rose to about 7.26%. That was a sizable jump on Italy's problems, and that hurt all commodity markets because there was a flood back into the U.S. dollar. The U.S. dollar has been at a decline really since Reagan was president back in 1984. Now, the big question in Chicago is, will we do QE3? What's the stance of the Fed? I just offered that if we are to reduce our debt in this country as an economist, there's one way to do it a little painlessly, which if we print another 4 to 4.5% more dollars each and every year, that'll cut our debt in about half over the next 8 years. So we're the reserve currency. We may be able to get away with that. Other countries don't have that same opportunity. But I'm not willing to say yet that the dollar has made a long-term bottom. To me, as I look at things, we still think there's this pressure to print more, and that indeed we'll see the dollar continue to weaken as we look forward. I have not produced any conclusions because we'll leave that up to the panel. My purpose here this morning was to just lay the groundwork of where we are. And as I see it, we're losing market share in the grains, corn, and wheat. We've picked it up a little bit in oilseeds because of China, but it's the meats and value-added sector that has really been the shining star for American agriculture over the last 3 or 4 years. With that, I'll turn it over to my next panelist.
First off, I don't want to let this New England accent throw anybody off. The one thing, Sara, I am from Middle Tennessee, born and raised on a farm there about 10 minutes away from where they make Jack Daniels. So we raised corn, beans, wheat, cattle, and my ancestors probably did the first ethanol production for several people. So, it has been in our past for a long time. One quick thing to talk about as well as logistics. I know Dan, Tom, and I, all three of us travel overseas quite a bit. We were talking about it. Bunge has a pretty big asset base. Talk about Vietnam. We've got the first crushing plant that started crushing there in May of this year. We've got 4 plants building a 5th in China. The big thing around all this, I can tell you, I mean, a lot of origination, we do it, no doubt about it. But getting it there, we can make the best sale in the world, but we've got to be able to get it there and get it there efficiently and in good shape. This year has been an extreme, no two ways about it. And our competition, and I'm going to say competition, not in the U.S., but South America, the Ukraine, the Black Sea area, they're gaining a lot of ground on us, and we've got to maintain our competitive advantage. Railroad nightmares we had this year, I know a lot of you have seen it. This was flooding in the west, certainly around the Missouri River, a lot of deterioration around the tracks. This is an actual picture pretty close to where we're building a shuttle loader out in Montana. The Missouri River, they talk about the discharge at the dams up in South Dakota, 160,000 cubic feet per second. On the Mississippi River in Vicksburg, Mississippi, that discharge was around 2 million cubic feet per second, just to give you an idea with the floods that we had this year. So some very, very extreme conditions we dealt with, and I think it humbled everybody pretty quick. I think we've had 4 or 5 years of good crops, not a lot of extremes to deal with on Mother Nature, and then you see this, it can humble everybody pretty quick. But I don't know if anybody wants to take a guess. What day or what month do you think that this picture was taken? June the 2nd. There's an over, you can get it right. That snowbank's about 9 feet. So, gives you a real good idea of some of the extremes we faced this year. Railroads, I think, handled it very well. I did look at the guest list real quick to see who was here from which places, but it's not a advertising or to bash anybody. I think people handled this very well. The railroads, especially the western carriers, went to a lot of extremes to handle the commerce that they did and get back running as quick as they could. And obviously it wasn't very cheap. BN, you can see 375 million. Coal shipments were running very high, primarily around export, and we'll talk about that in just a minute. But, we did have a smaller crop for them to handle this fall, and the variabilities we've seen in freight. If any of you trade or are around rail freight, the variability around freight is huge, and it's not for the faint of heart. BN shuttle trains can run anywhere from, we've had a high this year, let's just say a month ago or early October, you were running $700 a car to make a trip. Within 2 weeks, that same car was $400 under. $1,100 swing on a $110 or a 110 car train. You can do the math very quickly, but it's a lot of money. But it just shows the variability in freight, and when you need it, you want it. You got to be able to connect destination, origin, and destination, and make it work. But for the first time, we are seeing freight at a surplus with a smaller crop, the space that the farmer has. And holding the crop, obviously very bullish. I can't ever think of a year that a farmer isn't bullish. But, all of a sudden $12 beans don't mean a lot. I mean, I want 14. Corn, if it isn't $7 or better, what are we going to do here? But also on the flip side of that, the input cost, the fuel cost, the labor cost, and making money, obviously the volatility is very big there as well. Railroads, again, another quick hitter here, cars online. You're seeing a very, across the U.S., an older fleet. We'll talk about barges in a few minutes, but a lot of the railroads have older cars, and investment to put new cars in. A rail car right now, a covered hopper, is about $90,000 to $95,000. I think a lot of us in this room, if you've been around transportation, a covered hopper used to be in the $30,000, $40,000 range. Scrap values are higher, but we are having an aging fleet. Now, the BN certainly has probably the youngest fleet that's out there as far as agriculture is concerned. They're running 119 to 125 of these 110-car shuttles now. You go back 6 and 8 years ago, that number was 55 and 60. So it shows what China and what the Pacific Rim, what's happening there, and where our exports are really channeling to. But it's also, are all around freight. How do we get it from the field to the destination the quickest? And obviously the PNW to Asia is the quickest route. But you can see the numbers there. BN has 67,000 cars, CP 43. I think the main thing over on the right-hand side is the velocity. If we'd have talked about velocity on the railroad in 07, 06, 07, and 08, we would have seen numbers probably a good 4 to 5 miles an hour slower. The economy was humming. You had a lot of cars on there between intermodal, certainly intermodal's automotive, containers. You had a thriving coal industry, a lot of power having to be being generated, as well as ag. 5 years ago, ag was probably the 5th to 7th revenue generator of, with the railroads out there on average. Today, when you go visit a railroad, the ag sector is either number 2 and in some cases number 1, but in most railroads, we're now the number 2 generator of revenue. I know personally, it's a good thing and it's a bad thing. I mean, it's good that we've moved up to number 2. The assets, the railroads are placing assets, crews around it, but they've also raised their rates enough. That's another big reason we're number 2 now, because these rates are a lot higher. But the velocity's gotten a lot better. On average there, you're about 22 miles an hour. Big, big item, and that's on a train from start to finish. You know, so a lot of times they've got dwell time while they're letting another train pass. They're on a side track, but to average that is very good. Barges, you know, to me, certainly something that's, we've got a lot of operations on the river. We still feel the river is one of the most economical places, obviously, to move freight or to move commodities. The lines here, hopefully you can see them, but I mean, you know, the blue line are barges built. The red line is what's being scrapped or exported, and I'll talk about exported barges and tows in just a minute. And then the green line's the total fleet, but you can see where that green line is. The marine industry has been very profitable for the last, I would say, since 2004, 2005. But if you go down to the numbers below and look at the blue line, I mean, you see a lot of barges being built, but look at that green line for total barges being built, or I'm sorry, in the fleet that's out there. The new barge today costs you about $650,000 for one barge. But that one barge today will haul on average with a 14-foot hull, will haul about 72 to 73,000 bushels of grain when the water's there. So big improvement, say for barges that were built back in the 70s that would haul 50 to 55,000 bushels. So basically when you try to replace, we'll just say 100 barges, you can build 75 and still have the same capacity. But what's happening here, the investment and the returns on that investment, you know, govern. I mean, we all are bound by working capital and returns on our investment, but getting a return on a $250,000 barge versus $650,000, big, big difference. Average per day returns need to be over $200 a day, every day, for a little over 35 years to generate a 15% return. You go back 7, 8 years ago, to 10 years ago, those per day returns were 80 and 90 bucks. You go back to the year 2000, people were tying barges off and paying somebody $25 a day to let that barge sit. So you don't have a lot of people just running out here to buy new barges and build them. Number two, if you did, you place an order today for that barge. If you're credit worthy, you don't have to pay a deposit. If you're not, you've got to pay a deposit, but that barge won't be in production for you until late 2012 or early 2013. So the capacity that's there, the shipyards, yes, they can put more back in production, but people are very cautious about doing this. So you can see the total fleet year on year. You know, we've gone from, you know, we're at 11,787 barges. That's where we were in 07. We're close to 1,000 barges less than where we were 8 or 9 years ago. So it's something that we, I think, all need to keep in mind. Consolidation continues. You know, we've seen the railroads consolidate on the barge freight or the industry fleet profile that's out there now. We had 36 operators in 2002. Today we have 16. And of the top 5, you're holding about 50 to 60% of the capacity within the top 5. So consolidation, we feel, will continue just because of the working capital needs and the money to run this business. Something that's really come around in a very big way, and Dan hits on it some, coal exports. You think of China, you think a lot about grain and food, but also coal exports are huge there now. As we scrap barges, I'll just say for Bunge, it's public information, we built 100 new barges this year. The barges we retired, actually we used them for 37 years and sold them for double what we paid for them 37 years ago. A lot of repair work went on in between. We had a lot, as I said, that stayed in the garage and only come out on Sunday, you know, for a grain haul, but, you know, the scrap is worth a lot of money. Also what's happening is you're taking a lot of these steel roll-top barges, taking the tops off, selling that top for $15,000, and going to a coal exporter and time chartering that barge for 2 years, 2 more years of life, because coal's very rough on equipment. But coal's becoming a bigger competitor for, you know, not only barges, but for towboats to move them. Also on the rail side, locomotives and crews. But that's going to China as well. Continuing on with China a little bit and corn, Dan mentioned production on a global basis. China this year, and you get varied reports, but you know the biggest number I've heard, and I think it come out last week, Dan, I heard a number of 189 million metric tons. I don't know that I have it exact, but probably 6 years ago that number was 136 million. Yeah, so call it 135, 140 million metric tons 5 years ago. Today they're at 189. And you heard Dan say it, Tom will talk about it too, China's importing corn. They're not doing it just to build a whole lot of stocks. They're doing it because they need it. You know, and that's something that the industry's trying to get geared for. If nothing changes, nothing happens, China right now is on pace to probably do 58 million metric tons of beans. They're going to be over half of our bean exports. If they start doing more corn, which we think they will, let's say they do 3 million metric tons this year, and I think that's what the government numbers will show. Could be closer to 5, but let's say it's 3. We feel like, I'll say from a Bunge point of view, that number is going to be 10 million metric tons inside of 2 to 3 years. But there's a lot of stipulations around it. How well we can perform. Can we meet their specifications? And we'll talk a little bit about biotechnology here in just a few minutes. But this is what I'm paying for, this is what I want. But we do feel like a lot more of the export capacity going forward. Beans are going to be there, but corn's going to start to make a big run. Back to marine equipment. One reason I'm bringing this up, barge retirements, and the light on the picture is not good, but this is in New Orleans, and on average, this is right outside our facility where we fleet our barges before they go to our export facility. But that is 26 barges that have been dry docked and primered or repaired, and you've got barges stacked on top of each other, and then what looks like a towboat that's running here. In this block here, you've got 18 barges. The remainder here, this is 1, 2, 3, 4 towboats that have been dry docked. And then here's the vessel that's going to push them down to South America. But South America is taking a lot of our retired equipment, and they're able to use it another 8 to 10 to 15 years. You know, their rivers are a lot deeper than ours, so they don't have near the wear and tear on the bottom of those barges. But you can take a barge at, say, 1978 to 1982, they'll pay $130,000 to $150,000 for that barge, do minimal repair. They'll take towboats that we're retiring and do the same thing, but they'll take it and run it for another 10 to 15 years. More infrastructure coming online. The road system down in South America still, or certainly Brazil, is still very tough, but they're hitting a lot more on the waterways and going to continue to gain a competitive edge on us going forward. Waterway improvements for us, and I know Tom will hit on this. This all sounds good. It sounds like a lot of money. Full appropriated, budgeted, 4.6 million. Operations and maintenance, 2.3. Construction, 1.4. How much money did we really get of that? I mean, we can take all that, and we're lucky to just do bare maintenance on our locks and dams and do what we call snagging of trees that have fallen into the river or minimal dredging around places that it needs to be done. Reason I'm bringing this up, you go back to South America, they got deep water. They're going to have a big edge on us with a lot of this equipment versus if we have if we have a drought start to develop here this spring. We don't have a lot of snow this winter. We've enjoyed good water on the Mississippi River for the past 4 to 5 years. We've been able to load to a 10-foot draft. You know, in a lot of cases, or at a minimum, a 9.5-foot draft. We start getting low water, we have to go to 8 feet. We start dragging a lot of barges, we have to do a lot of repair. You know, the point I'm trying to make is, you know, we've enjoyed some very nice circumstances the last 4 to 5 years that are bound to come to an end for a year or two. South America is going to still be in very good shape, water-wise, and gaining ground on us there. Biotechnology. I guess first thing, I'll show a couple of quick charts and go back to this. This is something Monsanto puts out, and certainly I've asked them if it's okay to show this, not trying to brag on their technology, but I think it's a very good chart. Showing in 2010, you know, we were sitting at 165 bushels to the acre, and at the time this come out, that's what the crop was forecast to make. When we ended, I think we're at 156 or somewhere in that range. But anyway, the point I guess we're trying to make here is look at the trend lines from the 70s to now, and then what we feel like where we'll be in another 20 years. You know, I think a lot of people are hearing, you know, historicals could take us to 200. Personally, we feel it could be better than that, 200 bushel to the acre corn. On soybeans, looking at 50 bushels to the acre on a trend line yield, average. You take this out to 2050, obviously, that's when they talk about 300 bushel corn and 80 bushel beans. We hope they're right. I mean, I know the previous panel mentioned the 7 billionth person. You know, I think we're looking at 9 billion in very short order. How are we going to feed them? As we were talking about in the corner earlier, you know, the big item here is once people get a taste of food, or I know as we say, once you've had filet, you don't go back to Spam very quick, or you sure don't want to. It's going to be the last thing you give up is food. And we feel like the ag industry, not because we're in it, but I know the previous panel said it, you know, ag is a good place to be. Is the bubble going to burst? Personally, I don't think the bubble's going to burst. Now, it might have a short pop, but, you know, land prices, yes, they're very high. Certainly production costs are very high. We've got to maintain the infrastructure and the competitive advantages we have now. Transportation is going to be huge. Biotechnology will be even bigger, I feel like, because the U.S. is still the best place or the quickest, I'll say, converter of water and energy into food. And we can get it there more economically than anybody else. South America is producing a lot of poultry now. We can still produce a whole bird and ship it to Russia or ship it to China quicker, more efficiently, safer than they can. You know, how do we continue to maintain that's going to be a big item for us. But certainly biotechnology is going to be a big, big item for us. Transportation, how does that figure in around biotechnology? You know, cross-contamination of products. And I'm not talking about you mix a few kernels of corn in with a bean cargo. You're allowed so much of that. But if it's an unapproved variety, it's a killer. And I don't mean literally, it's a killer on the sale. China has zero tolerance on unapproved varieties. And it's a very big item. I just can't say enough about it because with what we've got for traits coming online, you'll see the second comment there. Biotech agencies say that we have 9 soybean and 6 corn traits in the queue for approval. Now that's over the next 2.5 years. You had one variety this year that was not fully approved across the chain, and it can cause a lot of havoc when they want to buy corn, when that one group wants to buy corn. You know, we can't afford to not be aligned as an industry, and when I say as an industry, an export industry and a food provider, to not be aligned on a subject like this. It's got to take all the way from the producer to the seed tech providers to the grain industries and exporters to the industry associations. I know we've been involved in meetings with NAMA, I'm lucky enough to serve on the NGFA board. NAGA's there, National Corn Growers, you know, a lot of industry associations out there, and y'all have got a very good one. I know we're a very big supporter and enjoy being on with this association, but we've got to be aligned on our approach or we lose customers. You know, having visited them, they're very knowledgeable of what's going on with all of this, and they keep up with every bit of it. You know, and I'll close by saying, I think, you know, we have China today. You think about India and Africa, connectivity, the group before us was talking about connectivity, cell phones, YouTube, and so forth. In India today, they got 245 million cell phones in a concentrated area. Same area, you go over the entire country, they only have 80 million bathrooms. Think about it. I mean, they're connected, they've got the information, they know what's going on, they watch what they're eating, they watch what we're producing, and they're a lot more educated than what we think about what they're consuming. We've got to maintain that education base, I think, and really try to help people understand what we're producing, that biotechnology is not a bad thing. It's something that we've got to have to feed the world going forward. With that, we've got to have a great logistics infrastructure, getting it there back and forth between the two. But to me, the future of our entire production chain lies with this. Because you think about it, ethanol has been a great thing and still is, and I believe will be going forward. But if that DDG is produced and it hasn't been approved going into a feed product, they're going to go to some place where it has. So we've got to protect what we have here and stay aligned as a group. So you know, I think I'll end with the capacity situation. You know, we feel like there's plenty of capacity with these elevators. We've just built a new one. You know, it's a state-of-the-art facility that should be open here in January. We can unload a train in about 4 hours, and we can load a boat in less than a day, and we can do it with 6 people. So the industry's come a long ways, you know, in being able to handle grain. There's no bucket elevators here. It's all incline belts, so you have very little breakage. All the conveyors are stainless steel and fully enclosed. So from an environmental point of view, you know, it's very safe and very efficient with no dust emissions. So this is what our customers want to see. They want to come over, how do you handle my grain? And then at the ports where we unload, you go to China, they've got modern ports that are able to handle this grain very well. So the infrastructure is getting started. We know we got to make repairs over time, but you know, here again, if we don't have that customer base, all of this is for naught. So, thank you.
I can't wander and talk at the same time, so I'll use the podium. But it is good to be here. Thank you, both Dan and Bailey, for, I think, some very instructive insights. I just came back from China about a week and a half ago, and when you're talking about value-added exports, I completely concur. If you're in Beijing and you deal with the smog, you realize that it is no longer because of the coal-fired plants, because of all the automobiles, and what they desperately need is an oxygenate in their gasoline. And I would not be surprised at some point that an ethanol import market develops in that area, or at least there's a potential for it. It's good to be here. It's good to see a lot of old faces. This is really a unique event, a unique organization, because it's an opportunity once a year to really get together and frankly discuss some interesting things. And so I am delighted to have an opportunity to visit with you today about U.S. agriculture exports and the challenges of trade. Dan and Bailey actually laid out many of the key messages, and I'm not going to try to repeat too much. Matter of fact, I probably should just sit down and say, okay, I agree, and let's get on to the conversation. But I am, I guess, charged to speak for a moment or two. So I'd like to begin, in all honesty, with a success story. My comments will be somewhat grain-centric because I represent the U.S. Grains Council. That's what I'm supposed to do, and we represent producers of U.S. corn, barley, sorghum, and particularly DDGs in the international marketplace. But what my comments are is not related solely to them, but also all related agribusinesses who are interested in export expansion. And what I can say about them, and particularly about U.S. corn exports, can be fairly stated about U.S. agriculture as a whole, very much along the lines of what Bailey just said, is that we are, in fact, even with all these challenges, a tremendous U.S. success story. We're one of the bright spots of the U.S. economy as a whole. Agriculture, in fact, runs a significant trade surplus, even with China. Exports generate over 25% of all U.S. farm income, and I think it's important that we not lose sight of that. And they will add nearly $40 billion to the plus side of the national trade balance. In short, we are the world trade leader. And I would suggest that we actually begin from a position of strength, but yet we can and should approach the future with confidence, because what we have to sell, in all honesty, the world wants and it needs, and I'm not telling you anything you don't already know. The bottom line is, and this is something you'll hear from the Grains Council a lot in the coming months and years, that when trade works, the world wins. Trade's not a zero-sum game. It, in fact, increases the pie. And U.S. farmers also win. And that's important to remember, because our job is to help make trade work. I began by acknowledging the success story of U.S. agriculture and U.S. agricultural exports. But as our old friend Paul Harvey would say, we need to remember what the rest of the story is. And it's simply this, and it's again what you've already heard: success gets copied. Satchel Paige's famous quote can and probably should be understood as meaning the reverse of what he actually said. And in my view, that's what makes it a bit funny. You recall that what he actually said was, don't look back, something might be gaining on you. The fact is, however, a warning like that is actually an alarm. And it's an alarm that you better look back, because something probably is, in fact, gaining on you. Try this on a dark street sometime, or try it with your kids. The moment you say, don't look back, it's all eyes to the rear, instantaneously. And in a market economy, when you have a successful product or brand, something gaining on you, or at least trying to, is almost an assured certainty. Why? Because the basic premise of success is simply this, and that is that success in market systems rests on fundamental social, political, legal, and cultural adaptations. And not all societies figure it out overnight. It's that simple. But markets make success possible. And around the world today, people in ever-increasing numbers are coming to the realization that wealth is mostly created. It's mostly created. It's not generally found or taken. The market exchanges are not zero-sum, and that growing the pie is far more productive than trying to steal away the next person's share. But that ultimately makes for competition. Every corn producer understands that $7 corn changes the incentives. It will pull acreage from other crops. It will pull fallow land back into production. But I want you to remember that it is also underwriting the investments in technology and infrastructure that other major producers need to boost yields. And the battle for market share is, and it will become, intense. I urge you, each of you, to simply sit down at some point and look at the difference, nominally based, in land values between the U.S., the Ukraine, South America, Brazil, Argentina. Do the math. It's interesting. So the question is, what does the United States need to do to maintain and build market share in an increasingly competitive world? I suspect many of you have already seen this slide, but we need to begin by keeping our eye on the ball. For U.S. agriculture, continuous export expansion is really nothing more than a make or break proposition. Why? Because technology continues to advance, just like old age. Yields and production continue to grow. But the simple fact of the matter is domestic markets are saturated. A majority of Americans get a personal reminder of this every morning when they step on their bathroom scales. And you know, from a U.S. agriculture's point of view today, the important realization absolutely must be that 95% of the world's population live outside the United States. And much of that 95% is just now climbing the ladder to prosperity, which includes, amongst other things, protein-rich diets. This slide actually is a snapshot of our markets of tomorrow. And what it's telling you is that by 2020, over 600 million more households, that's 600 million more households, not people, will join the global middle class. China is actually the single biggest factor in the graph, but every part of the world that contributes, and I would urge all of you not to forget about where India is today and where she might be in 5 or 10 years. If you extend the trend lines further out, aggregate world food demand is expected to increase by at least 70% by 2050, and some suggest it will need to double. And therefore, the question for us is, how do American producers position themselves to compete for these opportunities? You know, it's important to remember that we're not the only ones who have this chart. Our competitors have it, and they can do the math. The potential is there, quite frankly, and we are, in fact, going to have to compete if we're going to win this market. You saw an iteration of this graph already, but the bottom line is that successful competitors begin by thinking about their customers. So it is important to begin with a recognition that for much of the world, food security is actually the threshold question. And the solution to food security begins with production capacity. But it doesn't end there, because that is where it actually begins. You know, in the United States, we tend to take food security for granted. America has been a land of agricultural abundance. As we all know, we have been incredibly blessed. But most of the rest of the world has not been so fortunate. In much of the world, food and food security remain a very critical concern, and it tends to be defined, quite frankly, in another way, and that's called food self-sufficiency. And this translates, whether we like it or not, into numerous obstacles to trade, including policy support for domestic domestic agriculture, as well as innumerable number of barriers, both sanitary, phytosanitary, and other non-trade barriers to imports. And to overcome these barriers, we must, amongst all other things, focus on trying to build confidence and trust in the reliability of U.S. as a long-term supplier. This chart is, in essence, nothing more than a promise of abundance, and it is therefore, in my view, an implied safety net for prospective customers. It's a common expectation, as we've already heard, that average yields may be approaching 300 bushels per acre by 2030. That's not a guarantee, but it clearly is a plausible future, and it's a plausible future that most all of us in this room really do subscribe to. And it is a future that is still not, and I think this is important to recognize, not fully comprehended by our own policymakers in the United States, let alone by our foreign partners around the world. So a key task is going to be to work patiently and consistently in order to ensure that this potential is acknowledged and ultimately appreciated. And we're doing this at the Grains Council. You know, we had, for example, this past summer, an opportunity to entertain and host a high-level delegation from China. We spent 2 weeks touring them through the United States, and you know where we started the tour at? At Mount Vernon, the home of President Washington, the first science-based agriculturalist in this country, in conjunction with a number of his peers, including Ben Franklin. The single purpose was to show them the gains that could be made in production agriculture if you focused on science and market opportunities. We then took them to meet some policymakers, and then we went to the Chicago Board of Trade. We took them to the Federal Reserve Bank in Chicago. We had Keith Collins give them a crop insurance seminar so they understood risk management. We took them to the seed tech providers, DuPont, Monsanto, Syngenta. We ultimately took them into several fields of 200-plus bushel corn so they could see firsthand what was possible with technology and market and appropriate risk management strategies. And then we ended with them seeing some new export facilities on the West Coast. What we did was simply try to make it possible for them to understand that we do, in fact, have the capacity to be a reliable supplier. In addition to that, one of the things the Council has found out is that for a variety of reasons, the U.S. is not always considered the first supplier of a high-quality product. And as a result, what we have done this year is launched the first of which we think will be annual U.S. corn quality surveys. And these are designed expressly to inform our foreign buyers about the qualitative attributes of the U.S. crop based on what I would suggest are a transparent and impartial methodology. I anticipate that if this is done properly, it should become a tangible marketing advantage for U.S. corn in international markets. And why? Simply because, in my view, transparency is as important as anything when it comes to building confidence. The U.S. trading system is, in fact, the most transparent in the world. But let me suggest that so, too, is political reliability. And our customers need to know that the U.S. will not engage in export bans or food embargoes if they are to develop confidence and trust in food security through trade. And they certainly need to be assured that they are not to expect legislative and other sorts of activities that would impede on their ability to access our markets over the long term. These are assets which we can build on. We're going to have to build on them if we're going to build the confidence necessary to build the brand, if you will, of U.S. agriculture as what I would suggest is a trusted, proven partner and a reliable bridge to the world's most advanced and productive agricultural system. This is another slide that we too have borrowed. I think it's a slide that many of you have seen, because the second key issue in this whole issue of trade is technology acceptance. This illustration is a very general and partial snapshot of the U.S. corn technology pipeline. It's based on an informal survey that seed tech companies have provided to many of us over the last year. I suspect it's far from complete, but what it suggests to me is the dynamism of the U.S. scientific and production systems. You know, we tend to take this for granted. Most of the world, frankly, does not. And the evolution of world opinion and national policies on agriculture technology is one of the great areas of challenge, but I would suggest of opportunity today. You know, international acceptance of biotechnology is grudging, but it is growing slowly and surely. And this is likely to continue because the world needs higher yields and because the world is increasingly committed to sustainability. Biotech, as you all know, allows us to do both. It has dramatically boosted yields, and it will continue to do so. You know this, but I would again suggest to you that many in the world do not. It also allows us, as you all know, to reduce things like irrigation, significantly reduce soil loss, reduce energy, reduce agricultural inputs, pesticides, nutrients, etc. But cultivating a greater acceptance of biotech is going to be a key trade policy objective for the Council. And to this end, the Council is engaged in an ongoing strategic dialogue with China, as well as other trading partners on biotech issues. This dialogue is predicated on a mutual respect for differing cultural sensitivities and regulatory systems, but it is also an irrepressible issue, and the direction of this evolution is clear, and we must pursue it. But once again, remember Satchel Paige, and be forewarned that biotech research is ramping up around the world, and particularly notable in China. Leadership has to be earned. It has to be earned every day, and it cannot be taken for granted. In fact, some research we've seen recently would suggest that China is doing some innovative things that will perhaps shock all of us at some point. A third key dimension is, in fact, infrastructure. It's already been discussed at length. For decades, we have taken U.S. infrastructure for granted. You know, our internal rail and highway systems, our internal waterways and ports, were actually second to none. By now, you already know what Satchel Paige would say about it. Bailey has covered this in some detail, so I will tread lightly. But let me say that the Grains Council's theme, and this was put together before I was asked to make a presentation here, our theme for the year is, quote, your highway to the world, new capacities, new markets, end quote. Our chairman of the board chose the theme quite deliberately. He lives along the Mississippi River. You know, the bottom line is that the U.S. has stood on a pat hand for too long. Our infrastructure is aging. The deferred maintenance backlog is huge, and it's growing, and as this chart shows, we are not keeping pace with a number of our competitors. Note that the figures on this slide are per capita investments. Note also that the chart doesn't adjust for geographical size. We are roughly on par per capita with China, but China happens to have roughly the same land area we do, but 4 times as many people. Since infrastructure tends to generate economies of scale, that's a significant advantage to China. You do the math. You can do the math for all the countries on the chart. A year ago, some of our members were in Panama, where they met with representatives of the Canal Authority. The canal, as you know, is being significantly expanded. And this is an interesting factoid. The new channel will allow boats that will contain 12,000 containers, 4 times the size of the largest boat that can go through the canal now. 12,000 versus 4,000. It would suggest to you that the logistics and the technology outcomes of these are fairly significant. The Grains Council doesn't lobby, but the simple fact of the matter is we do inform. And at every opportunity, we remind everyone who is willing to listen that America's competitive position is not guaranteed. It frankly has to be earned, and world-class infrastructure is essential to that effort. The road ahead to trade policy. Again, the question is, what should the U.S. do now to compete for the markets of tomorrow? Simple fact of the matter is, as I've already discussed, the one thing that I want to get to, because I think we're running short on time, is a little bit of commentary about China. China is actually the current new big growth market for U.S. corn. China's emergence as a main corn importer is, in fact, a big story. And I think greater is the fact that in 2010, China became our #1 ag export market for the United States. In my view, it's important to put this in perspective because China's corn imports from the U.S. in the 2010-2011 marketing year ranked it with Syria, the EU, and Venezuela, one of the top 10 U.S. markets, but well behind the leaders. The key question is, where is China headed today? China has rapidly increasing domestic demand for meat, poultry, and dairy products. China has immense potential to boost its own output, but there will be an ongoing dynamic tension between those two factors for years to come. So we need to gear ourselves up for that. It's not going away, and yet, in my view, it's a market worth working for. On the left of this chart are the USDA's final export figures showing the top U.S. customers for the For the 2010-2011 marketing year. Japan, Mexico, Korea, Egypt, Taiwan, Syria, the EU, 27. This year shows China at 977,000 metric tons for the crop year ending August 31st. But so far this year, through last week's USDA export report, China had already committed in excess of 2 million tons, in excess of what USDA's projections were in the October WASDE report. Today's WASDE report that was out shows China now being in the market as a corn importer for 4.93 million metric tons. And you heard Bailey's projection earlier. The simple fact of the matter is that China is a market that's here, it's here for real, and it's one that we are going to have to work hard to develop. And so consequently, I think that we need to focus very heavily on an effort to re-engage in the value of trade and trade policy. And this is a bit of a pitch, but you know, we have tended to, I think, become a little bit dismissive of the go-around of the WTO. It's not been very effective. Everybody's kind of given up and walked away from it. But the bottom line is that a rules-based trading system can, in fact, create a great deal of value, and particularly value for U.S. agriculture. I want to close with one quick story. Last April, we had a team of folks in Geneva for the simple fact of sitting down and trying to find out where the round was going. For those of you who have happened to listen to presentations by Director General Lamy, the head of the WTO, they can be a bit droll, dry, whatever you want to say. I don't suggest to be an expert in WTO rules, regulations, and the negotiation process. But as I sat there and listened to him, he was very dismissive, very pessimistic, and there wasn't really much to be taken away from that whole discussion of optimism. And I finally looked at him and I said, Mr. Director General, let me ask you a question. I said, is it not true that China's economy has grown by 10% a year for the last 30 years? And that most of the Southeast Asian economy, Malaysia, Indonesia growth has been something in the neighborhood of 8 to 10% a year for 10 to 12 years, and that India's growth has been something in the neighborhood of 8 or 9% a year for 10 to 12 years. And amongst all this, the U.S., outside of the last couple of years, our economy has grown 3.5% a year, and on and on. And he said, yes. And I said, that doesn't count everything that's taken place in South America. And he said, that's right. So I said, let me ask you a question. Who the hell did we steal all that from? He kind of got a smile, and I said, trade is not a zero-sum game, is it? He said, no. I said, it grows the pie. Everyone benefits. Everyone ends up economically better off if they participate in it. Is that not true? He said, yes, absolutely. Well, I said, then why do we make it such a negative-sounding drill in the first place? I said, why don't you explain the optimistic, the positive side of this? And he looked at me and he said, well, Mr. Dorr, I only have 5 people in our press agents, or in our press office. I said, well, I got a hell of an idea. Why don't you hire 4 more? The bottom line is that trade does benefit us all. And I don't think that we can overlook that, and I would urge all of you to recognize that 25% of the U.S. agricultural sales come from trade, and we need to focus and focus intently on it. Thank you all very, very much.
Well, thank you, Tom, and I think you can realize why we had invited such dynamic heavy hitters to this panel to give you not only the future of trade and the export markets for the United States and around the world, but looking at the kinds of challenges that we're facing. And I'd like to tee up our first question so that we can have Dan respond first and offer this to our other 2 panelists as well. But as many of you know, President Obama has established a national export initiative in which he's aimed to double all exports, not just agricultural exports, but all exports over the next 5 years. Now, some people have lamented until just recently with the signing of the South Korea, Panama, and Colombia trade agreements, that they really haven't seen very much aggressive action taken in that regard. In fact, some would argue that our trade policy has been basically a low-dollar policy more than any kind of really aggressive action. So if you were king for a day and you were able to say what we should do in order to give the United States agricultural exporters that competitive edge again in order to meet a very aggressive goal of doubling in 5 years for ag exports, Dan, what one or two actions would be at the top of your list that we should take?
Well, the one action I would have is making sure that science is behind every decision on trade that's made. In other words, by saying that, have standards that adhere for both meats and grains around the world in such that disputes are mitigated and that we all know that what we're dealing with. But too often, buyers, from my perspective, here's an example, Tom, and I'll throw this at you. On the Seine River in Paris in the end of June, I sat down with the largest wheat buyer in the world from Egypt, Gasc, Mr. Mari. And we sat there and talked about the U.S. quality of wheat, how good we were, where we're going with it. And he looked at me and said, well, I will never buy Russian wheat because they cost us $80 million last year and they're not reliable. 2 weeks later, the Russians dropped their pants by $30 a ton. What did he do? He bought Russian wheat. And so this gets us back to the problem of standards and reliability. And so far in this market, it's still the low-cost seller that ends up getting the prize, if you will. And it's hard for us to compete oftentimes against the Black Sea and other areas.
Bailey and Tom?
I'd go with, after that, I'd say food and feed safety. I mean, to be able to ensure, to educate that consumer that they know what they're getting from us. I mean, I think we all would rather under-promise and over-deliver in a market like this. And here again, with the connectivity that's out there, we're dealing with a more educated consumer than we ever have before.
Mm-hmm. Good point. Tom?
Well, I don't know that I have a lot to add because I think they've covered the gamut. The one observation that I've probably taken away from the time that I've spent in China over the last couple of years is that I don't think there's any shortage of technical working groups trying to work through a lot of the technology and science issues. I think what there is a shortage of is solid policy and legitimate political effort. We hosted a roundtable with all the life science folks and a number of traders in China a couple of weeks ago, and we heard this resoundingly. One of the biggest challenges that we have right now with trade in China from an agricultural point of view is simply resolving the chicken issue. And until that issue is resolved, it will be an impediment to almost anything that we need to deal with, including some of the biotech issues that Bailey alluded to and others. And when you look at the chicken issue, it's not a high dollar matter. It's not a big deal. But there's a number of people that have gotten their skivvies wrapped around the axle, and it's very difficult to get resolved.
Thank you. And I'll be welcoming questions and comments from the audience as well. Just raise your hand if you have anything, because otherwise when you put a journalist as a moderator, you have no shortage of questions that I'll just ask. So I'd welcome anyone from the audience that wants to answer, to ask a question. Ed, Steve?
Hi, Steve Mercer with U.S. Wheat Associates. Talked about alignment, and as they look forward, one of the areas that they think is going to be important is identity preservation. They're actually moving toward more high value commodities. Do you disagree, Bailey, that the grain industry, their value, their revenue capture may not necessarily be about identity preservation or actually recognize that there are many areas but can we manage the economy to be able to serve world market and at the same time begin to develop these value-added identity preservation?
I think over time we can. Let's face it, for non-GMO beans, I would go back 6, 7, 8 years ago. You used to have a premium of 20 cents to the grower, and you sold them in the export market for 50 and 75 cents a bushel. You hit a high of $4 to $4.50 2 years ago, and I know when we were in Japan, there was resistance. I mean, you got to the point that we can't afford this. A lot of it goes back, I think, to another approach to it, to the grower. You have fewer and fewer producers that are willing to do the IP or the IP, I'll say grains, whether it be corn, beans. Obviously, wheat's not necessarily there yet, but I think it's, is the market going to be able to stand it, or do you commoditize more of the IP? And I'll use, for instance, the Howlaic on the beans. Does that become more of a commodity bean 5 years and 10 years from now that takes care of a lot of the trans fat issues?
I'd add one component to that, because I think Bailey is being a little bit humble. I think the new facility that their firm is involved in Longview, the EGT export facility, is quite frankly the first component of a legitimate IP system. As conveyor belts are conveyor belts, not cup elevators. They're self-cleaning. You have the capacity to begin doing some very interesting IP things. I don't think that the commodity industry should rule itself out as being able to be cost-effective in developing IP issues relative to food safety and a whole host of other things. Combine manufacturers are working aggressively to develop self-cleaning combines. When you look at radio identification, tag, dust that can be scattered into your combine tank, and you can begin to identify clearly these tankfuls of grain that may or may not have an approved event. And you know where they're isolated because when you probe it, you know where you're at. These are technologies that are, quite frankly, all pretty much there. It's an issue of scaling them up. One of the things, and I'm not going to, I can't go into detail about it, but the U.S. Grains Council has just got back a study that we have not finalized for public consumption yet, but it's called Food 2040. It's taking a look 30 years out at the kind of food demand and the kinds of food and the expectations that consumers, particularly in East Asia, will have by 2040. And it's stunning. And it's stunning about the opportunities, in my view, that it's ultimately going to create for the U.S. food industry if we're willing to reconfigure ourselves to reinvest capital in the opportunities that are out there. So I think the answer to your question is yes, we can be, but it's going to take a new commitment. It's going to take a new set of standards by which we operate from.
And Tom, you've been very active in political circles and acknowledging the role that the government has played in foreign market development, as well as programs like the Market Access Program. Those are under threat right now because of the budget situation that we're in. Is there going to be enough money from the private sector, or what role do you see the government playing going forward to perhaps offer support and the underlying layer of investment to continue these sorts of market opening activities?
Well, I don't know that I have an answer to that question. You're referring to the Market Access Program and foreign market development funds that historically have been made available to all of agriculture and those who are involved in what are known as cooperator programs. And we've all felt very strongly that they bring great value. Yet when you look at Dan's trend lines in terms of where they're going, one has to legitimately question whether or not you're getting your money's worth out of it. Now, I would, quite frankly, hasten to point out that as some of those trend lines decline, you're transforming the other ones that are going up. And so I think it would be easy to lose sight of the success of the programs, and I would encourage everyone to strongly support them, but on the other hand, understand the challenges they present. For example, if in fact at the APEC meeting later on this month, Japan decides to join the TPP, that will commit them to having to reformulate their agricultural programs. Japan today takes roughly 15 to 16 million tons of corn a year, most of it from the United States. Yet if they have to reformulate their agricultural programs, I would expect our corn exports to Japan would decline, but I would certainly hope that we would replace it with more pork or more poultry or dairy products. And I would then simultaneously, from a quite self-serving point of view, point out that one of the reasons that they've developed these appetites and these demands and these opportunities for these meat exports is because those in the grain business have facilitated the development of the capacity, the understanding of how to develop those systems, and so that there is a quid pro quo. There is a trade-off in that, and the gain may in fact be increased domestic consumption on the back of what was done internationally through these other programs. Simple fact of the matter is that in this budget environment, everybody's going to have to be on their best behavior. They're going to have to make the best case they can make. And they're going to have to look very closely at what they're doing and whether it's productive or not. And if it isn't, you're going to have to change things.
Thank you. You know, along that line, there's also been a push to invest in infrastructure, a national infrastructure bank. And Bailey, you did a great job laying out all the challenges we have being competitive with overseas customers and our waterways and our railways. I know we were up in North Dakota a couple weeks ago, and they said they can't get 100-unit car trains because of the what's happening with the oil industry there. That they're having trouble, you know, finding train availability of trains. So, what kind of a federal investment do you see going into infrastructure and solving some of these logistical problems that you laid out?
Well, I think number one, you know, for our locks and dams, there's so much more there that needs to be done along the waterways that needs more immediate attention. I think the railroads, the profitability has been there for them to reinvest as far as their tracks, ballast, and industry has come along and invested in equipment where it's needed. But I think a lot, the main focus, in my view, would need to be on the locks and dam system and port dredging, because that's one thing with all the floods. We're already seeing it in New Orleans now to Southwest Pass. You've got a reduction in drafts there, primarily from Katrina, that it still needs to be cleaned up, but it's just plain old dredging funds. That's something that's year after year. It can't be a one-time fix.
Dan, any other thoughts on
You know, we're all talking about infrastructure. We're all talking about government payments, where we're going. And I got to tell you, as an economist, I'm just really disappointed in some things that I see right now. For instance, we just had in the last week Census Bureau, or the last couple of months, Census Bureau tell us that they're not going to be providing soybean crush data anymore. Or, for that matter, soybean oil stocks or meal stocks. So now we have USDA people that are going to be guessing at what our stocks of soy products will be and what Bailey's trying to do in terms of a crusher. And it's sad that in this country we have someone of that importance guessing. Second of all, you in media, I would tell you that here we have dairy exports at 13% of U.S. dairy production. I can't get data until 2 months after the fact. The pork people have tried to push USDA or Census to come out with this data more frequently. If we're going to be in the export business, we got to have this data far sooner so that our producer clients and our commercials can make the decisions they need to make. So not only is it infrastructure, I would like all of you to push for the data, whether we now have beef exports, pork is coming, but there's a lot of other avenues that we need to have. In the case of beans and oilseeds, they're taking it away from us.
And I think the same could be said for the NAS data. Everybody's critical of NAS data, and that would take not really a great deal of money. That's not a huge expenditure, and it's one that's a real foundation to the industry.
It's a shame. It really is.
Well, and certainly we don't know what's going to come out of all these budget cuts, but USDA has already taken that proactive move to cut back on several of the reports. Right. So I guess that's a good marching order for everybody to keep in mind as they leave this session, is to stay engaged on the collection of data and also to stay very much on top of the opportunities that these gentlemen have laid out with the export market. I think we have one final question here, and then we're going to be able to break for lunch.
I'd like to address a question to Daniel. In your opening comments, you mentioned that the ethanol industry is starting to slow down, and I'm not really sure what you mean by that. With the RFS2 at the very beginning of implementation, which is a 30-year program to mainstream biofuels, both biodiesel and ethanol, into a national market. I'd be interested to hear how you came up with the analysis that it's slowing down and what you actually meant by that.
Well, what I meant by it is you're talking about RFS2, which, you know, we start getting into advanced biofuels and some of those sorts of things. The traditional corn ethanol base that we have today, if you look at plants being built, we used to increase U.S. corn demand by 400 to 600 million bushels a year by all of these new plants coming on. Now, as I go forward, it's something between 150 and 200 million bushels as we start to get closer to the mandate of 15 billion gallons by 2015. So we'll peak out at that point, as the data now stands for corn ethanol, somewhere around 5.6 billion bushels by 2015. Today we're at 5 billion. So the growth on ethanol for corn will be slower. Whether or not we'll see advanced biofuels being cellulosic and other things go, make that next leap is interesting, because heretofore we've not been able to hit those mandated targets that is being suggested. Now, EPA just came out within the last 10 days and said that they see, because U.S. gasoline consumption is flatlining or declining, that we're at that 10% saturation point, which then means that Brazilian export side of 1 billion liters is so important. So my point is, I don't expect the blender's credit to continue after December 31st, nor do I expect it for biodiesel, just because of budgetary pressures and the political change against ethanol, if you will. Not that it's anybody's fault, but just that the industry has reached that mature phase where legislators no longer see it as being needing the capitalization or the subsidies that it's once had. And again, cellulosic ethanol is a great idea. Problem is, we just haven't commercialized it to a point that we can meet some of that forecast going forward. I don't know if anybody else has anything. Tom? Or?
Want to add to that?
I think that's pretty self-explanatory.
All right, well, thank you very much. And to Dan and Bailey and Tom, let's show our appreciation for great insight. And Lisa, we turn it back to you.
Thanks, Sarah, and thank you, panelists. I think they've all given us plenty to think about going forward. We'll now break for lunch, and that's going to be in the Chicago Ballroom starting now. And we will be back in this room at 1:30 for the session after that. Thanks again.